Here we go, some multiple choice questions on our internal control frameworks. Let's begin. An entity that maintains a strong internal audit function that reports directly to the board of directors is applying the ideas from which principle of effective internal control over financial reporting. Now, just a side note, if any of you have worked in audit or could be various facilities in the accounting world, you might know this ICFR over and over. You might be familiar. Internal control over financial reporting. I remember in my day repeating this over and over. It's just a good time, right? These trigger words, bringing you back to your career. All right. Well, what are our thoughts here? Well, we're looking for a principle. Now, that's a kind of a giveaway. Are board of directors and human resources a principle? No, these are more of actual roles and functions. These are people, human resources and board of directors. We're looking for a principle, and authority and responsibility and organizational structure are principles. These are, again, roles in a company. So that's why I would eliminate A and C. How about B and D? Now, authority and responsibility isn't really a principle. Remember, we're going to need to memorize the organizational structure. We're going to need to memorize the internal control framework, and organizational structure is for sure going to be one of ours that we need to memorize, whereas our authority and responsibility, not so much. So basically, which of these is one of the principles, and which of these specifically relates to strong internal audit functions? That's going to be organizational structure. Now, the board of directors is going to be pretty well involved here, but the board of directors themselves are not the actual principle. That is our trick, one of our tricks, and hope you all did well on this one. If not, practice. Within the COSO internal control integrated framework, which of the following components is designed to ensure that internal controls continue to operate effectively? As we did with the previous question, first step I would do is eliminate any false answers, any answers that are not components of the COSO internal control framework. However, they seem to all be components. So that is check number one. Okay, check number two is we are concerned with the one that is designed to ensure internal controls continue to operate effectively. Two approaches here. I would recommend being familiar with both, because with these questions, you can never practice enough in the memorization world. Well, straight up, as we saw in our lectures, monitoring is going to be the function, the component that ensures internal controls continue to operate effectively. But also think about this, continue to operate effectively. Not establishing them, not setting them up, right? We are sustainable. We are continuing to operate effectively, and that's monitoring. You're monitoring them to make sure that they continue to operate effectively. Risk assessment, not that one. And information and communication, not this one either. Again, two approaches. One is just straight memorizing that monitoring has to do with designing components to ensure that they continue to operate effectively. And then also, just think about it for a second, right? Which one makes sense in your mind? You're essentially monitoring your controls for flaws or breaches. That is what you're doing here. Next up, in a small public company that has few levels of management with wide spans of control, each of the following mitigates management override of controls except which? Now, let's put ourselves in the perspective here. You might be thinking in a lot of these questions of a big company, we've got one person, one executive for each different function, each role, so it's super easy to implement segregation of duties. However, in small companies, because it's a smaller company, maybe less revenue, and it's just there's less to look over, you might have a couple executives that have a couple different functions themselves. So much more difficult to have separation of duties. And as such, we see we might have problems there. But let's read the questions. So each of the following mitigates management override of controls. That is basically when you have a control, right? And management, because they are a higher level individual, they can kind of say, oh, yeah, no, I'm not going to do that, right? Because maybe your control is that the a staff accountant has to send something to someone else and they sign it. And as someone in the executive level or the management level, you go to that staff accountant and say, hey, don't worry about that. I have authority to override this control. And the staff accountant maybe doesn't know any better or just has to obey and listen to the manager or the executive. And that staff accountant just says, okay, here you are. So that's a management overriding controls. So each of the following mitigates them except which? So establishing an effective and anonymous whistleblower program with which employees can feel comfortable reporting any irregularities. Now, this one for sure, that is going to help mitigate control overrides. If you have an anonymous whistleblower program, right? Like, so that staff accountant now, after that happened, the staff accountant can now anonymously go report that to this program, can call in, doesn't have to give a name or anything, can just be an anonymous source. And if the staff accountant feels comfortable enough, that's a great way to fight against management overriding controls. You can report something and say, hey, I saw out of the corner of my eye that this executive was doing something that they shouldn't have. Establishing a corporate culture in which integrity and ethical values are highly appreciated. Well, think of a culture of a company. Now, maybe you have experienced this or you have not. Either way, that's fine. There are companies out there that you hear about in the media and the news that are not ethical. We don't really know what percentage of the company or the employees are not, but their culture seems to not really value ethics and integrity. However, if the company through and through values ethics and integrity, then there's much less likely to be overriding management controls, right? So that is going to be a answer here as well that helps to mitigate management override controls. If everyone's got pure heart in their bodies, then much less likely to see overriding controls. What about having two officers who significantly influence management and operations? Well, this answer immediately triggers something in my mind, and I'm not going to say the only way, but the most effective way to beat separation of duties is through collusion. Because if you separate all the duties among different people, but these two individuals collude, come together, then that's really the best way. And, it's kind of hard to beat that. That's what this answer is saying is collusion. Two officers significantly influence management and operations. They could collude and easily override a bunch of controls. So this one's looking like it's not going to help mitigate. If anything, that's going to be harmful. And then having an effective internal auditor function. Yeah, if you have an effective internal auditor, that's pretty solid way to mitigate override controls. As such, we are going to choose here letter C. Two officers having most of the power is not good for your internal control, your separation duties. Awesome. So an effective remedy for this would be to disperse those responsibilities among other members of the organization. And as a small company, that might be impossible. It might be hard because you can't afford to hire other people. So that's just an inherent risk with a smaller company. According to COSO, each of the following is an example of an appropriate ongoing monitoring activity. I'm reading this and I'm thinking back to our mnemonic. I'm thinking back to our monitoring in our COSO components. Each of the following is an example of appropriate ongoing monitoring, except which. So, periodic analysis of variances between expectations and actual results. What would this do? Well, this would allow you to essentially see if maybe the numbers are being fudged. If you're periodically analyzing variances between what you expect the results to be and what they actually are, if the actual results are really skewed, then that monitoring function of overseeing it might help you catch something that is either an error or maybe fraud. So this is appropriate for monitoring. Follow-up of customer and vendor complaints regarding amounts due and owed. Now, if customers and vendors are complaining, either means you're probably underpaying them, right? You're underpaying the vendors, or customers are not getting what they want. This is an appropriate monitoring control, because maybe you have an employee who is skimming some of the money off that is going to the vendors. Great way to catch that is to have a monitoring function to make sure that any complaints, because obviously if vendors are not getting enough money, they're going to complain. And that is an issue that could be caught through monitoring and could help you catch some fraud. We're going to catch that fraud before it happens, right? Or at least at the very end. Okay. Approval of high dollar transactions by supervisors. Okay, what are your thoughts here? So think about this one for a second. This one, is this an example of an appropriate ongoing monitoring activity? Well, approving one-off transactions here, just we assume they're one-off, it's high dollar transactions by supervisors. This is not considered consistent and ongoing. That's the logic in this question is ongoing activity, monitoring activities are consistent and ongoing. Like we saw in that previous question, they're meant to just be sustainable, right? To constantly monitor what you had set up. Now, this is one-off. This is one-offs, right? So you've got a couple high dollar transactions. That's not consistent and ongoing, right? That's the thought process, the logic with this question. And what about comparisons of information from various sources within the company? If you're constantly double checking information with various sources in the company, if you're constantly checking with HR to see, does this person work here? Or if you're constantly checking with accounting or finance, that is a consistent and ongoing evaluation of monitoring your internal controls. And as such, letter C is our answer. And again, that reasoning is because that is not consistent and ongoing. That is one-offs here and there. The Treadway Commission was established to study factors that lead to fraudulent financial reporting. The commission was established by who? Now, a lot of times they're going to try to get you to think it was the government who set up this Treadway Commission, which established our COSO, Internal Control Framework. However, it's not the government, and as such, it's not SOX 2002. SOX was the government, as well as the SEC is the government. So it was not the government. And you see this one, you think, Treadway Foundation probably set up the Treadway Commission. That's not the case, actually. The Treadway Foundation, that's not the answer. That's not what set it up. Private sponsoring organizations is the answer. This was a bunch of companies, private companies came together and said, we want to make ourselves look better. We don't want investigations coming after us. Obviously, companies, I'm not saying they were angels, but they did have their own reasons for having this set up, but they wanted to take some flack off of themselves. So they created the Treadway Commission and set up our COSO internal control framework. It was established in the mid-1980s, so that might help as well because SOX 2002, when was that established? Take a wild guess. Established in the mid-1980s, the Treadway Commission and COSO. Different periods in time. All right. Employees of an entity feel peer pressure to do the right thing. Management appropriately deals with signs that problems exist and resolves the issues. Things are sounding great so far, right? Things are sounding wonderful. We're in paradise. And dealings with customers, suppliers, employees, and other parties are based on honesty and fairness. Wow. Sounds like an ideal world. Isn't that lovely? According to COSO, the above scenario is indicative of which of the following? Okay, great question. Well, how do all of these generally happen? And like it says, what is this indicating? Tone at the top? Yeah, if there's a serious tone at the top of integrity, of employees feeling peer pressure to do the right thing, if everything's fair, there's no bias, there's no related party related party transactions are fine, but unfair related party transactions, then tone at the top sounds to be a pretty solid answer. Strategic goals, this is more long term. So here's an example I would give. In my high school, we had a president and a principal. The principal was responsible for more day-to-day activities, which is more tone at the top. Strategic goals was more like the president. The president is more involved with long-term strategic goals. That's the difference here if you had any confusion. Strategic goals, this is more day-to-day. Strategic goals might be, shift our profitability or reduce fraud within the company over a long period of time. More vague, not vague, but more broad, overreaching, long-term goals. More mission statement. Tone at the top is more day-to-day. Operational excellence, you see the word excellence and you think, okay, we're excelling, but this is more, think about our operations. Our company, is it operating fluidly? Are we pumping out product and collecting money? This is important, but that's not what we're describing here. This is, we could be a quite efficient, profitable company, but that doesn't necessarily mean we have all of this integrity. Reporting reliability, this is important as well, but this has more to do with our financial statements. Are our financial statements accurately reported? In this case, doesn't really have anything to do with that. Again, is this helpful for reporting reliably? Sure, but this is, again, much more tone at the top. A great solid tone at the top would establish this sort of integral, positive, ethical framework. Wonderful there. According to COSO, which of the following components addresses the need to respond in an organized manner to significant changes resulting from international exposure, acquisitions, or executive transitions? Great question here. Okay, first, like I said before, we need to assess. It's asking for a component. Are any of these not components? Well, all of these seem to be components. Okay, so there's no trick answer here based on that. What would likely, so let's run through. I'm going to look at monitoring first, just because we've seen questions on that already. Does this question seem to hint at anything about consistent and ongoing evaluations of existing internal control? As I'm saying it, no, this isn't really anything of that nature. We're responding to changes resulting from situations such as these. These might not happen a lot. It's not consistent and ongoing. So I'm really not going to think about monitoring activities here. Control activities. Control activities much more in line with control environment. Tone at the top. Are we having a positive internal control environment? Again, I don't really see anything in this question about control activities. I'm going to cross this one off as a result there. Then we have risk assessment and information and communication. Which of these sounds much more likely? Well, information and communication is more external reporting. Are we communicating properly? Is our information correct and accurate? And then risk assessment. Is this, like right here, international exposure, acquisitions, and executive transitions? All of these sound, and significant changes. I mean, all of this sounds pretty risky. That's kind of what I'm hinting at here. Just like if we're thinking about the concept of inherent risk, if you've got a highly levered derivatives trading firm, that has much more inherent risk in it than maybe a simple burger joint. Now, I mean, in terms of is it easier to start one versus the other, I'm just saying in terms of the business model. I'm trying to paint the highly levered derivatives trading firm as much more complex. It's got higher inherent risk in understanding its business model. Here, all of these sound pretty risky. Transitioning executives, I mean, that could be super risky. Acquiring a new company, pretty risky there as well. I've seen a lot of acquisitions go quite poorly. International exposure, I mean, think about how many companies have tried to expand globally and have blown up in the process. So risk assessment is super important for these, whereas information and communication, again, has to do with more reporting, but risk assessment is critical for all of these. It addresses the need to respond in an organized manner to these changes of not as common, super risky activities. Let's finish it out here. According to COSO, which is the first ongoing monitoring step in evaluating the effectiveness of an internal control system? Gosh, they just love monitoring. I'm the one picking the questions. They're the ones writing the questions. Some of these probably were written by me as well. Let's take a look. Well, which is the first ongoing monitoring step in evaluating the effectiveness of an internal control system? Do we identify changes in internal control that have taken place? Do we establish a control baseline? Do we reevaluate the design and implementation to establish a new baseline? And do we periodically revalidate operations where no known change has occurred? Great questions. Let's think about this for a second. The first step in monitoring. Now, let's think about if you were monitoring a company in terms of, let's think from an audit perspective. You're constantly monitoring Best Buy to make sure that their company is rock solid, right? That you want to give them a solid audit opinion. A great step is setting up a baseline, right? Setting up a baseline and saying, okay, we expect generally they're making X amount of revenue. They make X amount of revenue per X amount of sales. And you set up that baseline. And if things are skewed from that baseline, then that's probably more of an area of concern. Baseline materiality, right? Materiality is super important with the concept of an audit. And all of these others, so establish a new baseline. Well, you're not going to establish a new baseline until you have a baseline. So I would cross off letter C. Okay. And identifying changes in internal control that have taken place, again, sort of same logic. You're not going to identify changes until you establish a baseline. You establish a baseline of internal controls, and this is how the company operates with those internal controls, and then you can identify changes in them each year as you assess. And then lastly, periodically revalidate operations where no known change has occurred. This would be if you establish a baseline, then you're revalidating operations in those internal controls after the baseline's been established. So this is the process. You establish a baseline, and then you execute these functions. You assess. Maybe you assess things that have changed significantly. Maybe you assess things that have not changed significantly. All are valid processes, but only after you establish the baseline, right? You can monitor something much more easily if you know how it should look. And that is the process. All of this, again, is based off of our COSO integrated framework chart, all of the memorized components from our lecture. You're monitoring a company and their internal controls for flaws or breaches, and you want to make sure, as a result, that the controls can adapt to changes in risks. This was our last question here. Hope you all enjoyed and had a good time, and I'll see you in the next one. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.